for the afternoon session, sometimes when you look at the economic calendar, there is an absence of any significant medium or high impact news events. When we have a day there that has an absence of any news drivers in the morning, that tends to be a rather lackluster, rangy type, false breakout, and then pull back down into the previous day's range type of day, or reverse if it's trying to move higher. So I try to look for reasons to anticipate an afternoon move, because the morning session can tend to demand a lot more experience. You can get caught offside. You can think you see something that's there, trade it, and then it reverses and goes the other direction, or it goes into a consolidation. If you go to forexfactory.com and you pull up today's calendar, you'll see that there is a bond auction today at 1 p.m. I'm going to talk a little bit how to use that, how to trade it. I've never taught my students that. It's not a terribly volatile report. It's not something that you're going to burn the house down with, but it is absolutely something that you can trade. It does give a little bit of volatility. It does give you a little momentum to work with. And if you have a little bit of a narrative, you can find some setups. The main takeaway is for you to understand that there has to be some reason for the setup to be there. And majority of your time is going to be spent waiting for that very thing to occur. Now, that's not to say that the market isn't moving all the time. It absolutely is. But just because it's moving and gyrating doesn't mean that you're supposed to be in that right now move. That right now move may be completely diametrically opposed to what you are trying to do for your trade, because your trade may span outside the realm of the next 20 minutes or the next hour or today's entire trading session. You may be trying to nail down a trade that goes for weeks. So there's a lot of room for you to make what it is I've taught your own. That way you can take it and apply it to the marketplace, a time frame, a scenario that you're looking for that meets and fits your personal, unique personal life, schedule, and the aptitude that you have using the information I've taught. Predominantly, most of my content is allowing and affording all of you as students to find your own mold, your own way of framing these things. When we look at times of day, like I said, I'm pushing Caleb into the morning session. So morning session is his focus, but the afternoon session has its own characteristics as well. So if you are just looking for a way to get in the marketplace or how to trade and get in, you can clearly find that on my YouTube channel. It's absolutely easy. Silver bullet, optimal trade entry. It's a matter of what is it you're trying to do. And if you go into the mentorship, I will teach you very specific elements about short-term trading, day trading, swing trading, ultra short-term scalping, and they're very specific elements. But it's assuming that you have already done the work of looking at all of the broad brush concepts and modules that I have on this YouTube channel. For someone that's brand new, just stepping out and says, I'm going to watch 5 videos from ICT today, you're not going to walk away understanding it. All it's going to do is give you better foundation, one more cog in it, and those pieces come together when we're watching real-time price action. You're not trying to hold your feet to the flame and say, I have to know what it's going to do right now. It's not realistic for you to have that at the early stages. And you got to give yourself permission to do that and have that peace of mind knowing that keep doing what I'm showing you how to do, and it will come by default. It will be a response naturally, because you'll see these things repeating over and over and over again. And what will be exciting for you is that you see them occurring at the time of the day when they should occur. The new day opening gap, high and low. And we're going to talk a little bit about that because, Caleb, that's going to be like a lot of what you're aiming for as an underlying narrative. So while you may be aiming for an intraday or intra-daily session, relative equal high or relative equal low, to draw to as an objective for your trade, it's going to be linked to a new day opening gap and or new week opening gap. We talked a little bit about how at 7 o'clock, at 8 o'clock, and at 9 o'clock, the immediate 30 minutes after that, or each one of those top of the hour intervals, we want to anticipate a opposing direction in the marketplace. So the assumption is you have already identified after 7 o'clock a relative equal high or relative equal low, or where price is smooth. And then you're anticipating, you're not arm wrestling the market. You're not forcing that it has to go there because you now see it. So therefore, it can't do anything but go there. That's not what you're supposed to be doing either, which is why I taught you in the first 2 sessions together, is just to relax and observe. You have to sit back and watch what does price do and record your observations. If it means taking screenshots as price is going and moving around, and it may not be near anything of any particular importance, like an order block or a fair value gap or something like that. The idea of you using these intervals as a starting point, a delineation in time. So, okay, now I'm really focusing. It's 7 o'clock in the morning. Whatever's happened overnight during London, whatever's happened in the previous day's trading, I'm not factoring anything in yet. I want to see the design, the engineering of liquidity. And what does that mean? When price creates these really smooth areas of relative equal highs or relative equal lows after a session changeover, meaning at midnight New York local time, that's the beginning of the real true day in financial markets. So the algorithm likes to refer back to that time, and then everything since that time, it'll refer to for the purposes of liquidity or inefficiencies. Outside of that, you'll have things like new week opening gap and or new day opening gap, which is what you see here on the chart. What that is, and every day except for Friday, and this is for specifically the index markets. Okay, this is not something to lose your mind over. It's really simple. The market closes at 5 p.m. It stops and it pauses for an hour, and then it resumes at 6 p.m. If you take your 1 minute chart, it's something that is a long-term effect on price action. It'll be used for weeks. Here is the 459 candle on a 1 minute chart. My candles that are bullish are green, and my candles that are black are bearish. So the up close candle, that is the closing price where we stopped, and it's the last print for NASDAQ on Tuesday going into the 5 o'clock stop. And then at 6 o'clock, all you do is simply get in front of your computer, wait a couple minutes right before 6 o'clock, and wait for the first print on a 1 minute chart. When it opens up, that opening price, you drop a line segment on it, okay? And what I do is, all I do is like take this little line thing here, a horizontal ray, and I just go and I drop it on the opening price. You can annotate it any way you want. When you highlight and annotate your chart, you have to do this. If you just put these lines on your chart, and you're going to have about 5 of them, because you're going to use the present week, or if it's on the weekend, the new one that forms on Sunday's opening price. You annotate that on your chart, and then you'll have 4 more prior to that. So you're always going to have like a floating reserve on your charts of 5 weeks for new week opening gaps. 5 days look back for new day opening gaps. So when we have these levels annotated like this, you can call it whatever you want. You can label it the way you want. But I taught my students that this would be referred to as the new day opening gap high. Now, why is that? It's the new day opening gap high because at 7 o'clock in the morning on Wednesday, and yes, that gap forms technically on Tuesday evening, but that's really technically a gap or inefficiency that is attributed to and should be used for the basis of Wednesday's trading. But at 7 o'clock in the morning, there's 7 a.m., and if we scrub this down here, you can see that we are way above that new day opening gap. See that? And since this is the first level you would come to, that makes it what? The new day opening gap high. You can have a gap. In this case, we have a gap that has gap down. So where we closed here on this candlestick there on Tuesday at 5 o'clock, we open lower. You see that? When we drop down to it here, what we have done is we left this portion between this candle's low, or whatever this one is, whichever's lower, that little segment of inefficiency is still present. Because what is it lacking? Sell-side delivery. Not sell-side liquidity, sell-side delivery. If you look at this candlestick here, we opened and traded up. So there's nothing passing down into that candle's opening price. It's not offered yet. When we annotate our chart like that, these gaps will be referred to for a week. Now, sometimes you'll see they actually get referred to a couple weeks later. Still, they'll be sensitive because they're real algorithmic arrays where the market will refer back to them. The fact that these exist, and once they get traded to, anybody else that looks at gaps would think, okay, it filled the gap, and that's it, throw it out the window. Everything I serve up as a PV array is piping hot and fresh every single time. It doesn't get stale. But for the rule-based trader in you, new day opening gap, this is the part where you write down your journal, folks. New day opening gaps have a life cycle of 5 days. You can use them longer if you want to, but for the teaching purposes, when I taught new day opening gap first, they can act like magnets where it draws price back down to them because these levels, these gaps, have real value in them because there's an absence of any real trading. Even when you see them open up initially here, we can see that it opened there, it traded above the previous day's close. Does so here and comes back down and then runs back up, stays around in here, runs back up, stays around here, drops, consolidates, drops a little bit, and leaves a small portion. Let me say this part first before I get any further. Here's the closing price on the Tuesday at 5 o'clock. We opened down here, so that's a lower gap opening. The opposite would be this, where we opened above that closing price. So if we opened up here, then you would draw the same lines the same way, and you're using this ray down here. That extends it in perpetuity. It keeps going to the right. It never stops projecting it to the right. And your annotations, when you annotate them, put it on the middle and to the right, and then you label it. Real important that you put the date in it. Helps you organize the level of importance. So what does that mean? If you have a new day opening gap, say for 2 months old, and we haven't referred back to it since the day that it formed, in that instance, I would find it important. I have a journal page, and I write down every single new day opening gap, high and low, and its midpoint or consequent encroachment. And I keep a running log of that. And as long as we're 150 handles in close proximity to any one of them, then I personally will look at them. So I'm kind of like showing you my hand a little bit today. So for you, because it's something probably new to you, and you're probably going to have a whole lot of them on your chart because you're going to think that you have to have every single one of them until you run away from all the ones that you're presently trading around. You don't want to clutter your chart up. But I like to see them. And in my journal, it has a spiral page that it's basically a column. And I write down what that market is, and it's usually just the S&P and the NASDAQ, and sometimes the bond market. The high and the low and the consequent encroachment and the week that it opened up and formed. So for instance, this is for Tuesday on the day it formed, but is it for Tuesday's reference? No, it's for Wednesday's trading, and that's why it's labeled that way. You're going to use the next day after the 6 p.m. candlestick. So if you look down at the bottom of the chart down here, it says Tuesday, August 6th. But really what we're doing is we're building a reference point for Wednesday's trading and for the next 5 days. So that means this will overlap into next week. 5 trading days, not 5 calendar days, 5 trading days. If you have a holiday, skip that and add one more day to it. And that's kind of like your life cycle for new day opening gaps. New week opening gaps go back with a life cycle of 5 weeks. So you're always going to have 5 weeks of new week opening gap. And a new week opening gap is where we stop trading on Friday at 5 o'clock and then where we open up at Sunday at 6 p.m. And then you mark it the same way here. The only difference is you would say NWOG, which is new week opening gap. They tend to be very sensitive still 5 weeks back. Now, that's not it's ended at 5 weeks and you can never refer to them again. It's just a general rule or principle that you can start with. You're going to discover that they work 6 months, 9 months still away because they are actual places where the market didn't really efficiently trade, as I'm showing you here. But if you take the levels, once you have them on your chart, in TradingView, you want to create a layout that has a title that maybe it's new week opening gaps. And on that layout, the only thing you have referenced for the market that you trade or markets are simply just the new week opening gaps. Or you create a layout that has the only new day opening gaps or new week opening gaps rather that is salient to your market. So that way, if you're ever watching price action or if you start your new trading session today, when you pop up one of your layouts, you'll have the information right away populated on your chart. And you don't have to have all that stuff on your chart when you're working with the chart time frame that you're exercising or executing on. So I'm saying that for the folks that are working, because I'm physically sitting down with you with a laptop. I'm trying to teach it from a perspective of using a single device like one laptop. So that way it helps you manage your information and not clutter your chart all up. But once you have them on, this is how you get the other levels that are important to me. You use the low, drag it up to the close, which is the high or new day opening gap. And here is your consequent encroachment. That's the midpoint. Why is it consequent encroachment and not equilibrium? Because equilibrium is a range that has been delivered up and down. Think of it like a trading range. This is not a trading range. It's a gap. It's a real gap. So that real gap has a missing level of buying and selling. There's really no buying and selling yet because we stopped trading on the previous session at 5 o'clock and then resumed trading here. So there's nothing being offered as a buy or sell, no printed trades until that opening right there. And then it starts trading. But what is it doing? It's delivering buy side delivery. That means it's going up. So what is it lacking? Sell side delivery. If we take this level here and we add 75 and 25, 0.25, 0.75. What that does, it grades the range into equal quarters. Look how it stops perfectly right there. What's that price? 18,049.50. It stops exactly right there. Perfect. You can't improve on that. Look how price gravitates around the upper quadrant. See that? And it expands just a little bit. Here we have the upper quadrant, midpoint or consequent encroachment. Consequent encroachment is the midpoint of any gap or any inefficiency. That means if it's a SIBI, down close fair value gap, the midpoint is consequent encroachment. The best shorts will form at the lower half of that because you want to see the upper half left open. A midpoint of a BISI, which is an up close fair value gap, the best fills for going long are going to form in the upper half of that. You want to leave the lower half open. Why? Because you want to see it create a breakaway gap. That inability to fill in that area down there, and if it rallies, that indicates to you that the algorithm is really going to start spooling quickly and you anticipate large range expansions. So this lower quadrant, beautiful, consolidating. It trades just outside of the new day opening gap, and the market trades down. Look at the sensitivity on the upper quadrant. You see that? Look at that. It's staying very, very close to the upper quadrant, and then boom, we trade down to consequent encroachment. And then one more time, look where it trades, that lower quadrant. Does it one more time just to take the low out, but does it come down and touch the very, very low of the new day opening gap formed at Tuesday, 6 p.m.? No. So what's it doing now? It starts to rally higher. We have this little segment of price action here that is inefficient. There's no trading down there. Once it formed this low, it starts moving higher. If you have these levels on your chart, even if this was to come down and touch that low here and then moved out of it, that does not make this high, that midpoint, or that low stale or of no consequence or importance anymore. It's still meaningful to me for 5 trading days. So if this is for Wednesday, this is for your notes. Make sure you write this stuff down now. Since this formed on Tuesday for Wednesday's trading, you have Wednesday's trading, so that's day 1, Thursday's trading, Friday's, Monday, and then Tuesday. So this new day opening gap is still valid until Wednesday next week. That's how I would classify it. Okay, so that way if you have any confusion about how long they're useful to me, or not that they're not useful, but I love the sensitivity around them for the next 5 days. Let's say it that way. Truth be told, I will use them 9 months in the past if it's within the narrative I'm expecting to see price behave around them. And that part is experience. So just know that what I'm showing you here is gold, and I'm going to show you how to use it a little bit more specifically. So we can see how the market leaves that area. Here's 7 o'clock, here's 8 o'clock, here's 9 o'clock, and we were way above it. We're really north of it when it formed those opening intervals. So 7, 8, 9, and we were way above it. So here we are. It went down and closed it in. The ability to want to see it gravitate back to them every single day. If you have the last 5, the week you're trading in right now, that's 1 day of it. And then you go back the last 4 trading days. So you have 5 of them on your chart. And as long as we're in close proximity to them, they're going to be impactful to your trading. And if you're bullish, if there's one above you, but there's several of them below you, this is gold dust. Okay. If you have a clustering of new day opening gaps, predominantly above where the market's trading at, and maybe there's one where you're trading at now around the market, or maybe it's below you, where do you think the market's more likely to go? It's going to gravitate where the multitude of inefficiencies existed, because it's going to give the market an opportunity to go back there again, because there are people in this industry that trade with this information that you're not supposed to have. And it provides that vehicle of entry, that mechanism of repricing up there. It has absolutely nothing to do with buying and selling pressure. And if it breaks your heart, get over it, because this is what really makes the markets move around, time and price. But you have to have reference points to know how do these markets book price, because they're going to use these hidden areas. Oh, they're not hidden, I see. Everybody knows about gaps. Right. And look at everybody else's use of them. It's going to be a gap fill, and then it doesn't fill the gap. It runs away. And then the gap's used later on at some other time. And once it fills, they're not always interested in it anymore. A la Chris Laurie. He'll say there's an inefficiency, a buy-side imbalance, as we call it, buy-side imbalance, sell-side inefficiency. He'll call that a liquidity void. That's not a void of liquidity. It offered buy-side delivery. There was buyers going on in there. What's absent? Sell-side delivery. That means moving right back over top of it and tamping over top of that run up in that single candle. So he would say, okay, we're done now. Once it filled it in, he's done. Next setup. Not me, brother. These things around specific times, they are absolutely useful and will be used by the algorithm. Now think about it. If everybody has the same logic that once a gap fills, it's over, then why would they fucking work again over and over and over again every time you trade back to them? No one's ever noticed it. I got over 2,000 trading books, okay? Not one of these jokers ever talked about it, ever. And the first time I started using this information to call the market in front of family members and friends and say, watch what it's doing right here. I don't have the levels drawn on it. I'm just telling them this is where it's going to go. So in other words, I'd have the level here, here, and here just in my mind. So, okay, I know that number. That's the one I'm going to see it trade to. And to watch their jaw open up, like, how do you know that? Yeah, it's good, isn't it? Isn't that good? Well, these things are always there. They're never going to hide it from you, folks. How are they going to change the gap? First of all, they're not going to be able to hide the gap from you. If we open at 6 o'clock, higher than where we closed at 5 o'clock, it's a higher gap. Okay. I don't care if it's an up gap or a down gap. I want to know what those levels are. What are they? The 3 levels here. Consequent encroachment, which is the midpoint, the highest high and the lowest low. What's the high? Whichever is higher, where we stopped at 5 o'clock or where we opened at 6 o'clock. It's a very simple process. It's not complicated. What's going to be complicated is if you're trying to have a lot of them on your chart. And you're going to look at this and say, what the hell am I supposed to do? This logic is very specific. Just look at the last 5. And if there is a clustering, if there's, say, out of the last 5, say there's 3 of them that are above price at the market price right now. When you are looking at 7 o'clock and 8 o'clock and 9 o'clock, anticipating that engineering of liquidity. But if you know that you have a series of new day opening gaps above, chances are they're going to want to gravitate to that. So what would that do for you as a trader? If you're anticipating a short, give it a chance in that first 30 minutes to try to reach in that direction, because they might spike it up there in a really thin price run to get up into those old new day opening gaps. Then wait for it to break down and show a market structure or a breaker, or look for an inversion fair value gap, like I tell you in the part 2 of this mentorship, how to see them. Those are so powerful. They are so powerful. That is one of the bangers as a PD array. If you can sit patiently, I say this about all my PD arrays in case you don't know that, but if you could sit patiently and wait for them to form, they will give you runners that just are so good. This type of stuff repeats over and over and over again. So when I spent time teaching, what I have made a real attempt to do is key your mind up and your attention to these critical times and conditions where the market is more predisposed to behave a manner that's one-sided. That's what you need as a trader. You need movement, number one. You need to be able to predict that movement, and you need to be able to predict the movement's direction, unless you're trading options, and there's a way to do that too, delta neutral, but that's another time. But in this case, we can see that these things tend to repeat every single day, every single week. So now, what's the difference between a new week opening gap and a new day opening gap? Well, there's 5 new day opening gaps in the course of a week. You only have 1 new week opening gap. So what do you think has more impact on a swing trade? A new day opening gap or a new week opening gap? A new week opening gap, because you're factoring the imbalance and inefficiency of a new week opening on Sunday at 6 p.m., where they've had a whole weekend to digest everything, and they use that opening price. If we have a clustering of new week opening gaps below the marketplace, I'm going to elect to see price try to gravitate to that. That's not a hard and fast, only going short. It just means that if I'm going to look for a long, I'm going to wait and see, do they want to drop it down there right away in that direction? Doesn't mean they have to trade to those new week opening gaps or new day opening gaps, either or. It's a filter that my mentorship students don't even know anything about. They're grinning right now because they're learning just like you are. And when you have these things recorded in a layout for your chart, you'll be able to see, oh yeah, there's a number of new day opening gaps and a couple new week opening gaps that are below price. And if you've seen, we've only worked it one time. In other words, like we've seen it here, it went down into this one. This is the first time we passed down into it. And this is the second time we passed down into it. If we've only touched the new week opening gap or a series of new day opening gaps once, they're really sensitive, like they're hot. They're going to see price draw back to them. That's just a guarantee it's going to happen. And there's very few guarantees in price. There's very few guarantees in trading. But this is something that you're going to study, and you're going to see. What I just said is the gospel. It absolutely is always there. And that right there cancels out the whole idea that these markets aren't rigged, because why would it care about a gap that filled weeks ago unless it's being called as a reference point through coding, and it's referring back to a certain span of time. It's a very specific reference of time that the algorithm will seek and look back to. And by having that look back period and looking at these reference points in price, so you have time and then price. And when you can identify these things, and they're never going to be able to hide where they opened the price up in relationship and in deference to where we closed it at 5 o'clock. Can you understand that much? What this does, it gives you a magnetized reference point of where bias can draw to, even before relative equal highs or lows form. Say that one more time, because I think I just heard you say you can predict relative equal highs and lows before they form. Yeah, you're fucking right. Yep. That's exactly what engineering liquidity is. So if you have a predisposed likelihood, if it's likely that we're going to draw down to a new day opening gap, or we're going to draw down to a cluster of new day opening gaps that haven't been traded to or used much, or a new week opening gaps that are clustering below market price, at what time? At 7, 8, or 9. You're referencing. You're trying to get a feel for what is it likely to do. Sure, there's going to be volatility. Sure, there's going to be probably all kinds of movement around. But what was the market showing us right away? Well, it's got relative equal highs, but it's also got relative equal lows from 7 o'clock at 8 o'clock. So if we know the new day opening gap is down here south of all that, down here, we know that it's probably going to run these highs. So you as a trader, Caleb, you're going to be thinking, I know that this is a gravitational pull on price. The algorithm is going to want to revisit this. If I notice that there's relative equal highs after 7 o'clock, that was the rules I gave you. Here's the high and the second one. And the market drops down. Do you chase that? No. Why? Because you have a new day opening gap down here that it's most likely going to trade to. It doesn't need the trade there today, as I'm going to prove to you in a little bit. You can be profitable without it never reaching that. It could do that return back into here in London, like tonight. It could trade there in London tonight if it hadn't dropped down there. And that's what I would have done looking for a trade in London. These highs here, that would be an ideal scenario to run those highs out. That would be a fake move. So that would be a Judas swing, okay, as we referred to before. If we have a predisposed direction in mind where we want to trade, where there's a larger draw or gravitational pull on price that's outside the parameters of just relative equal highs or relative equal lows, because that's just one piece of it. So you want to have a tool, a weapon in your arsenal that will help you understand with more probability, more odds in your favor, that the market's going to gravitate to a very specific range in price action. And that range needs to be a new day opening gap or a new week opening gap, Caleb. That's your black hole, if you will. It's going to draw price to it. It doesn't mean it's going to be a straight line to it. It just means that it's going to have an overwhelming impact on the overall direction of what price is going to do. There may be static price action moving around. It might have a little bit of flurry of rallies here and there, but ultimately it's going to bend the knee and go right to where it needs to go, which is the new day opening gap or new week opening gap. This is engineering liquidity. As the market drops down, we would never go short right away after seeing a new start of a new AM session at 7 o'clock and they have relative equal highs, especially if we're thinking a new day opening gap is a draw. So what we would rather do is we would rather see it trade up and cancel out this liquidity. So as it's dropping, traders are going to chase that. Think, yeah, this is really good. This is easy. All I got to do is follow the moving averages. Okay. Well, this level you would have on your chart, and you would observe that above this high is buy side. Okay, buy side liquidity or buy stops. The market rallies after 9 o'clock. We get this little squiggly line here, and then it pumps up above it. 1, 2, 3, relative equal high, then breaks down, and then creates another relative equal high. Are we more likely to clear these highs here if we have what I've been teaching you here? The larger draw, the more influential draw on liquidity are new day opening gaps and new week opening gaps. That's the magnet on price. And when you start mapping them out on your chart and keeping them active on your chart with the time reference points that I've told you, like the life cycle of them, for the sake of having more time used with them, you can create an additional layout on TradingView where you keep them for as long as you want. But just understand, knowing how to use them and managing them when they're older, you have to keep track of how many times they've been referred to. And it takes a little bit of effort. You can see the power of using this information once you start logging them in your own charts. You're going to see them in your charts once you have them. You're going to watch price do all kinds of silly shit that people on YouTube, on Twitter, on social media, if they're making their opinions public, the corners of your mouth are going to start aching because you're going to be smiling, grinning your ass off because you can see them falling victim. They're literally falling on the sword of the market. And then they're going to get sucked into emotion going right down to these levels or up to these levels in deference to when it's bullish. But you're going to see it and you're going to watch it unfold and you're going to have a perception over price that you've never imagined before. It literally is, if you remember watching Batman when he linked everybody's cell phones together and it was like a radar. He could see things because of their cell phones all being linked together. Or like the Matrix, when Neo finally saw the Matrix for what it was and he could just see it in binary code, zeros and ones. It's very, very close to that feeling, if I can use an analogy. Because you have a vision that's outside the candlesticks. You don't see the candlesticks anymore for just open, high, low, and close. You're seeing them as a black hole pulling price where everybody else is unaware. They're unaware. They have no idea what the fuck's going on, but they saw it when it gapped open at the beginning of the day. They saw it gap open on Sunday. Everybody knows about that gap. It's always been talked about. Gaps. Oh, everybody knows about a gap. Nobody knows about a gap. But they all know about it now. These areas of price will never be hidden from you. So therefore, they will always have effectiveness in your trading. There'll always be efficient compartments to a trading model that has a huge impact on what makes you successful in reading price. Therefore, as a default, if you can do entries that are very systematic, that have sound logic behind them, and you have small risk and you don't overtrade, potential profitability. And what happens if you do these things, these routines, these protocols, these step by step things, and you don't deviate from it? You don't try to reinvent the wheel. Yeah, I like ICT's rims, but I'm going to spray paint them my color and call it my thing. Don't change it. Stick to the things that I'm showing you. Don't embellish upon them. Just take that information and use it and be thankful that you got it. Because I didn't have to give it to you. I've been sitting on this stuff for 3 decades, man. And then what you'll see is when you can watch social media as a herd, when they start talking about when they're bullish or when they're bearish, or they say, oh, it's a crash, the market's crashing. You'll go and walk right in there and say, okay, I'm going to be a buyer. You go in there because you see that herd mentality going against an idea based on these principles. And if it's diametrically opposed, in my experience, the odds are going to be in your favor and less in theirs. And that's the key to trading with high degree of precision. You have smart money, precision, and odds in your favor when you're waiting for periods of time when the market's participants that are stupid, dumb street money, okay? Street money is my wife. When Bitcoin was just about to get to 20,000 the first time, but failed. And she said, do you trade Bitcoin? And I said, what did you just say to me? I said, do you trade Bitcoin? And I was like, that's it. Didn't even answer. I went right on Twitter. I said, that's it. Bitcoin ain't hitting 20,000. It's going to go. It's going to drop to 6,000. And it did. It's all history. It's all there. Her perspective is street money. It's the dumb money perspective because she doesn't know how to trade. She doesn't know how the markets operate. And here she is, she has an interest in Bitcoin because it had been going up. Everybody's talking about it. Well, there you go. You're near the high. But you have to think about, okay, well, here's relative equal highs. So they're going to run above that, right? Because ICT said they're going to run above the highs. You see what I'm showing you here today? This is underlying narrative. And you're coupling it with the engineering of liquidity. When you place the effects of what street money will see in price versus what a smart money perspective is over price, you literally are arm wrestling the strongest man in the world, expecting to win. It's not going to happen. This didn't stop going up because it ran out of buyers. This didn't go down and not go higher because it was more sellers. But that's the bullshit that you're told. There's a lot of talking heads that get paid a lot of money going around the world teaching that nonsense. The liquidity above these highs, it's traded to here. And then it runs a little bit higher and a little bit higher. And it creates a relative equal high here. And this is designed in engineering liquidity. And this is the part that where if you're anticipating a breakout move, you don't get filled. But if you're short, you're getting punished all day long because they don't want you a part of the move. You have to wait. Wait a minute. What do you got to wait for, ICT? What did I mention in the beginning of this lecture? The economic calendar, when there's an absence of any medium or high impact news driver in the morning session, where they're predominantly usually released around 8:30, sometimes 10 o'clock hour, like that you have the 10:30, you have the crude oil inventory number. That is generally, that morning time of day is where all the reports come out. And predominantly it's mostly given at the 8:30 But we had none of that today. But at 1 o'clock, we had the bond auction. So in my mind, what I like to do is I like to sit still and wait for them to get everything all set up for that bond auction to release at 1 o'clock. Now, you can look at the economic calendar and you can use what I'm showing you here today. Every single time they do a bond auction, if there's a day where there's no morning data, this is important now, because sometimes you'll have a bond auction, but there'll be morning news drivers. That doesn't hold true for this. This is a condition, this is a setup, and a part of determining the narrative where it's just a clean shot and you can just really anticipate it panning out, and you can trust everything I've taught before in terms of entry mechanisms, fair value gap entries, bearish breakers or bearish order blocks, and or immediate rebounds. That's some of the things that you're going to see that I used here to do a trade. Intermediate term price run for me is 50 handles or more for NASDAQ. And then you have a larger price swing is 100 handles or more. And I don't have any grading beyond that. But anything less than 50 handles is just, to me, it's like a scalp. Intraday trades, where you're swing trading intraday volatility, it's usually like a 50 handle or more price run. What this does is it engineers liquidity with the relative equal highs when the real narrative is it's going to drop down here. And if that's the case, and you don't know how to hold for the longer term trades, because the things I'm giving you here today, it's going to take time for you to grow into that. Okay, it's going to take time for you to get comfortable with it, to fail with it sometimes, and then wrestle with what that feels like for you emotionally and psychologically. And you'll see that you're going to do it wrong in the early stages a lot. And every single time you do it wrong, you have to treat those opportunities as an opportunity for you to go in and say, okay, what didn't I do correctly? And what can I take away from this? Don't look at it as it didn't work, I'm throwing it away, and I'm going to follow a live streamer and try to copy them. But you want to have some dopamine hit. Your dopamine hit should come by you following the rules and sticking your ass in front of these charts every single day and following the rules of engagement. That means process, practice, proficiency. In that order. That's how it happens. There's no circumvention or navigation around to get to the top of I can now do it because I did it in a shorter time period. Take the time element of how fast you need to get there out of it, because you don't know how long it's going to take you. You might be worrying about it. But then you have to really sit yourself down and say, is it ever going to get easier if you don't at least try to adhere to the rules? Because it's never going to get easier if you don't do that. But if you do it, even if you fail initially the first few weeks and find no value in it right away, you're working towards a baseline. And by journaling that experience, what you'll see over a month, at the end of the month, and you start looking back at the charts and you say, man, I had no idea what this guy was talking about, but now I see this shit's working. I can't get into the trade yet, but I can see where price is going. And when people get like that, that's one of the best feelings as a teacher, because you're learning the hardest parts of this. You think it's the entries and where your stop loss is. That's easy shit. I got 81 ways to get into that thing. Double that if you use it as an inversion. But you only need one. And the patience to wait for it with a narrative expecting price to draw to that. And if you can anticipate that, you don't need moving averages, you don't need trend lines. I didn't even refer to a daily chart. Notice that we're not even using daily charts. We're just using intraday volatility, time of day, time and price, liquidity. But the aspect of narrative, why price should be moving anyway, that stems from the economic calendar. Like we had nothing on the morning session. There was no data. That's why I scheduled my eye appointment this morning. But long story short, I afforded myself the time away from the charts, not worrying about any of this, knowing that the afternoon has that bond auction. Some of my students knew right away by me saying, I'm going to do the afternoon. And then I settled in at 1:45, give myself some time to grab something to eat, whatnot. And then here I am. That is maturity. That's patience. That's knowing what to wait for and what to look for. And also canceling out an interest where everybody else is going to try to break their ass doing something in the morning session. If you have no data, no reason for them to manipulate price in the morning session, okay, write this stuff down. If there's no data, medium impact or high impact in the morning session, try to trade the afternoon session, because the cleaner price action will be after New York lunch. When does that happen? As early as 1:30, but starting between 1:30 and 2:30, there's usually some kind of a sweet spot that forms in price action where it's just really, really easy to see it. And even if you miss it, you can start using what I taught you yesterday, where you can use a very sub 1 minute chart and get in sync with the price run that's already unfolding on a higher time frame 1 minute or 5 minute chart. So to answer the question, how to hold onto a trade longer, before you put on the trade, you have to have an understanding of where it could potentially trade to. Okay. And I'm assuming that maybe you're aiming for something like 100 handles or more, something like that. If you're looking for that type of trade, then you have to use your analysis that affords you that type of range. For instance, if I want to take 10 handles and I feel confident that I can get 10 handles out of the next price run, I got to look for something that's going to give me 15 to 20. Well, how do I determine that? Well, let's give this an example here. If this range is going to be anticipated that it's going to be sloppy in the morning, to don't trust anything in the morning and wait for the afternoon session. So what does that mean? I have to wait until at least 1:30. So at 1:30, that starts the afternoon session for me. Now, sometimes the moves can begin just a little bit before 1:30, and it's not a big deal. I don't care about that. But generally, I like to be in front of my charts at 1:30 because even if nothing forms in that next 30 minutes going into 2 o'clock, I know I can get something post 2 o'clock because there's a silver bullet at 2 o'clock going in from 2 o'clock to 3. And if I miss that, or it just doesn't, if I don't get a good read on it, or just simply doesn't do anything but goes sideways, then I'm going to look at it in the 3 o'clock hour to the close. And every single day it's there, but you have to look at it on time frames that will allow you to see it. If we're going to use the dynamic that was in play for today, obviously, morning session, avoid it. There's no news. And the only information that was going to be used as manipulation is that 1 o'clock hour when they had the bond auction. So the bond auction at 1 o'clock, that was my go-to. So I was watching and anticipating, okay, there's going to be a move. So I want to see something that is going to be used as a fuel for a run into this down here. But keeping in mind that if you're going to trade outside of just a relative equal low, if you're bearish, then you can, for people that have a better understanding, and that's not going to be all of you that are watching this, it's going to be students that have been with me for a while. You got to refer to what the market had done in the previous session, in the London session, for instance. Well, we have this low here, and we have this low here. What does that make that? What is this right here? Relative equal low. Does it meet the criteria I gave you as a filter? The most right side, in other words, there's going to be 2 swing highs or 2 swing lows, regardless if it's relative equal high or relative equal low. Whatever the one is on the right-hand side, if it's relative equal lows, it has to be higher than the previous low. Does it do that here? Yes. So the condition is there that this is a high probability relative equal low for the purpose of drawing to it. Now, here's a huge paradigm shift for you, okay? You're going to jump light years ahead in your understanding. The fact that we had the new day opening gap below that is a further rocket fuel that this is going to be easy to trade to. But in the beginning stages, you won't know these types of things and you won't have the confidence to hold on to it. So you graduate into doing it by taking trades that's just to aim for this, and then you demo trade it or tape read it. So in other words, if you're going to get to the point where you trust it, but you can't hold for a move down here because you just can't find it in yourself to do that because you're watching the profit grow and grow and grow, and it's probably the biggest trade you ever had in your life. And now you have anxiety because you're afraid that if you don't take the trade off while it's at the biggest point of profit since you put the trade on, what happens if it reverses? And you're going to feel bad that you didn't take out the full 1,000 or hundreds or whatever the size is that you're trading with, then leverage and affording you that profit. You're going to be worrying about that instead of watching and seeing, is price still behaving in a manner that supports the idea of it reaching to this level? Number one, to hold on to trades longer, you have to have something outside of the normal range that you would trade for. So if you're graduating from 25, 30, 50 handles, there has to be something that points to price going to something beyond that. If we're looking at that lunch hour and we know that there's news coming out at 1 o'clock because of the bond auction, I don't mind risk. Let's say it that way. If I do something wrong, I can go back in and generally fix that problem. When I was doing dominoes, and I used to manage the dominoes when I was younger, we had a running joke for any new hire that came in. If I was running out of dough, I would usually take the last dough and put my hole through it before I slapped it out into a pizza. And I would show the new hire and say, look, go into the freezer and bring me the dough repair kit. And it's a running joke. Everybody that works there knows it's bullshit. There's no such thing as a dough repair kit. But they'll look at you, nod, and they'll go into the freezer and look around for something that says dough repair kit. There's no dough repair kit. So I say that because you have to treat your boo-boos in trading just like that. In trading, when you have a loss or if you did a poor placement, maybe you took the trade a little too quick. You were trying to anticipate the setup versus waiting for the setup. And you may have to get out of it and wait for the real setup to form. And you may get a drawdown. You may get stopped out. And you may need to do something else, as a later setup. Well, the mindset that's needed to do that has to be in play also, because if you're going to be holding for longer term price runs, the potential for you to be stopped out prematurely increases exponentially, because in the beginning, you don't trust that the market's going to still work towards this direction. Every little retracement is going to feel like it's bottomed because you don't have that experience yet. When you start having these new day opening gaps and new week opening gaps and start waiting for price to gravitate towards them, that is like an exercise that strengthens your patience. But you can't fast track it. You can't make it happen faster because you want it to be faster. Like, you just can't download the experience of saying, okay, I'm just going to hold for these new week opening gaps or new day opening gaps, and I can trust it because ICT said so. So that's enough. No, you need to see it for weeks and months, and then over time, oh yeah, I can see what it's trying to do. And I'm not going to get tripped up by all these little fluctuations. But with that said, just know that there's a graduation point that you have to go to, which would be using this area right over here. So that's what I've been teaching you so far in the first 2 lessons, that we're looking for these types of things when the market is likely to go lower. What are we looking for? Caleb, we're looking for these types of things here. A higher low than the previous one, that are in close proximity to one another. So this is a target that we would use to aim for going short at a time when the market is going to be used to accelerate around that bond auction number at 1 o'clock. If you look in here, right here, here's one of those 81 PD arrays. The market trades up and starts to roll over. What time of day it's at? It's 12:42. So what are we approaching? That 1 o'clock hour, and the news is going to be released at 1 minute after 1. Okay, so basically this is 1 o'clock. So 1 o'clock, the bond auction number is going to be released to the marketplace, and then everybody does whatever they're going to do based on that. The understanding is this: that number comes out, and then traders are going to buy and sell. And the buying and selling pressure after that market release is done pushes price around. Bullshit. What's actually happening is the market's already starting to run lower. This candle here trades up. I want to see it be sensitive. This candlestick traded up into this gap. Now, if this was a PD array that I wanted to trade on, that would be my entry. But because I'm trading ahead of, no, this is the stuff that you write down. What do I do if I am not going to trade the fair value gap? What am I looking for ahead of a news drive? Because sometimes you'll see me take a trade before the news or before the opening bell. Okay, so if I know at 1 o'clock, that's when the news is going to hit for the bond auction. We already rounded over here, and we had a fair value gap there. The bodies are respecting it, and we started to displace lower. Just with this, looking at the chart like that, if it's just looking like that, in your rudimentary understanding of what I'm teaching, you already know the likelihood that it's probably going to explore below that low. Why? Because that's where liquidity is. And it's been going down all day, and this is the time it stopped and came all the way back up here and moved lower. Remember what it's gravitating towards down there. But now you have this short-term low here. By itself, that's a reason to be short. You have 2 factors. You have that new day opening gap as a larger, like, black hole wanting to eventually pull price to it. Then you have this low here where there's very short-term minor sell-side liquidity. So there's sell stops below there. Don't be worried or consumed about the fact that these highs are relatively equal. Don't let that bother you. Why? Because the market's moving lower and it's pulling to this. And even if it doesn't trade there during the day session, because this is the day session low here, during the 7 o'clock to this point, this is the lowest it traded to at that time. So there's going to be stops below that for anyone that try to chase this going higher. These relative equal highs, they can stay in play. They don't need to be upset. They don't need to do anything. The market's going to stay heavy and keep working lower. How do you know that, ICT? Experience, the fact that this is still likely to happen, and what's over here in the London session. So we have this low, and this. So what is that? That's 3 things. That's heavy factors on wanting to see price draw to it. There's no entry pattern there. There's no moving average, no indicator, no bullshit logic, except for its liquidity, and the market is operating on a narrative that it's going to drop to reach into that liquidity. Because if they're going to spend all this time above these relative equal highs during the 7 o'clock hour and 8 o'clock hour, and then they Judas swing into the 9 o'clock, this is all being held up there, tripping people up, chopping people up, grinding them all up, and then finally it breaks. I don't need to be a part of that, because the economic calendar, just like the TV guy used to do for me, would tell me when my favorite time in front of the box would be. The time on the economic calendar says that at 1 o'clock today, we have a bond auction. That's the only point of interest that I have on the economic calendar, and it's a medium impact driver. Not high impact, but it's medium impact. what that means is I want to be in the market anticipating this low being taken out, this low from London, that's going to be taken. And this is the part for those that if you are not able to hold the trade longer and you don't know how to get there, this is what you do. You take a partial below here and you close the trade here, and then you tape read the rest of it and you journal the shit out of it. You journal every single time you feel an impulsive feeling or emotional about the idea that maybe if you think it's going to not go down there, that's when you screenshot it and real quickly make a notation on it that I have doubts it's going to drop here. And then what you do is you look at that after the fact and say, okay, I didn't see this, so this is the takeaway. And you reinforce it positively. And by doing that exposure, you desensitize yourself to needing to be right. And it expands your comfort from getting into this trade and getting out. Maybe that would be the end of your trade. Or getting into the trade and then getting out below here and never seeing all this run down here. But it gives you that little cookie, that little reward that you did something. It was sound logic, but then you use everything past that time that you close the trade as a real focused, oriented drill to build your experience and exposure to waiting for it to pan out. Believe me, it doesn't happen overnight. It's going to take you a long time to hold on to price runs that just go and go and go and go. And honestly, you're going to miss a lot of big runs if you want to trade like that. And if you allow yourself to be beaten up easily, and you'll do it. Trust me, every trader does it. I should have held longer. I wish I would have held on to it more. I wish I wouldn't have took all the partials off. I wish I would have held the whole thing. That's all toxic thinking. But now anyway, we're going to go back into this area right here. I know that this is the time when the market should start running, because that's when the bond auction numbers come out. We're up here. I know I have a real strong likelihood it's going to at least take this out and maybe run below here going into that 1 o'clock news release. Well, here's the 1 o'clock, and then the market drops. Here, what I was looking at is I want to see, does it do this? Does it run up into this fair value gap there? There's your fair value gap. And what is it doing there? Does it at least touch the consequent encroachment or midpoint of that gap? Look closely. No, it doesn't. It gets real close to it, but it doesn't. Just falls short of it. The fact that it goes up there and doesn't touch it and then closes here, I know that right there is a bearish order block. I can trade after the next candles come up and bump into the bottom of it. I'll trade short there. All it has to do is move away from it and then come back up into that. I can trust this candle not being overtaken. What's the next candle do? Goes up to it, but doesn't touch this line, and it doesn't even breach the candle's high. Now, if it would have traded up and touched that midpoint and then did that, I would not have taken that trade. I would have waited for another attempt to get in there and work just a little bit above the consequent encroachment, and then I would try to go short in this upper part there. That's what I would have done differently. But because it didn't and couldn't even touch the consequent encroachment, these are PD arrays. And yes, they're used for very specific and static levels to enter and exit on. But I also use these same price points as a means of measuring strength and weakness. If this candlestick can't even touch that, but gets close to it, it's signaling. It's a signature. That's an algorithmic signature. For someone that knows what they're looking for, that tells me that when this candle closes, all I need to do is see it move away and come back up and touch the bottom of that, and that's a bearish order block. With that logic, I can be short and take a partial below here, or if I know that I can trust that it's going to go down below the London lows, then I'll put a limit order below that. And then I can sit and explain to my son that I think it may go down to those lows, but I'm positioned now that if it doesn't need to do it today, it'll probably go down there in the London session tonight. Where? To the new day opening gap down here. So with all of that narrative explained to you, so now we have the market displaced below the bearish order block. This candle here, we open, it trades up, touches it, goes short. Here's your low. What's the low of that candle? Look right here, 18,320 and a quarter. The fill, 18,321 and a quarter. So as it's bumping into that, I'm selling short. And I want to see it aggressively run below here. It does. Go back for a second. The fact that we traded up here and we didn't touch the consequent encroachment of this, I like to see if there's two fair value gaps, because we have here and we have here. You have to at least anticipate that it may go up into that higher one. But if it fails at the lower one's consequent encroachment and there's a news driver coming, I have no problem, no fear of getting into the trade. If I did it wrong and I get stopped out, I've shown executions where I've done this. You've seen me get stopped out, and then I go right in there and I do another entry and it pans out. Or if I did it wrong and I know that my direction was off and I'm offside, I reversed and did the other direction, and then the market just goes the other way. That is going to come by experience. So invariably, if I address or field the questions that come to me, A lot of these questions will be answered with your own experience. And it's an unfortunate cop-out sounding response, but that's the truth. You're gonna feel comfortable doing certain things that you aren't going to be comfortable even imagining doing at the beginning of your stages of learning. So I wanted to see this stay open. I wanted to see it fail to get to that midpoint of the lower one. Because it failed there, okay, wonderful. I'm not worried about it. But go back to what I was saying. If it would have touched the consequent encroachment in this candle, I would have anticipated trading up into the higher part of this. And then my stop loss would have had to be above the midpoint of this consequent encroachment. It drops down, and then we have an immediate rebalance. Okay, so we have the market trading down here. We have a big down closed candle. The market trades back up. Boom, bumps into it here, immediate rebalance, and then I get a little bit of heat here, but that does not take me underwater. This was only, it would still have like $1,700 in profit even with here. Why? How can that be possible? If I'm entering here, look at down here. If I'm entering short there, why isn't that giving me drawdown in the trade? Because the larger trade entry is here. There's 6 contracts here, 6 and 4. So 6 contracts at the higher price if I'm short. The secondary affords me, when I'm only doing 4 contracts, it affords me to trade above that because it could do what? It can revisit this fair value gap. It can trade inside that. But I don't want to see it do that. So I had to have a little bit of heat there, but it doesn't fill it. It just goes up to that level there. And what is it doing there? Is it touching the consequent encroachment before it makes the swing high here? Nope. So what does that tell me? It signals to me, just sit back and relax. Don't do anything. Just relax. Move your stop to your first entry, minus 2 ticks. And now we go into 1 o'clock. Look what happens at 1 o'clock. They pump it and then dump it. Small little fair value gap right there. All you're doing is you're studying price and you're seeing every SIBI. Remember I was telling you yesterday? When the narrative's in play and it's going to go lower, or your analysis is assuming that it will go lower, you're looking at how the market is treated at every SIBI, sell side imbalance, buy side inefficiency, or a fair value gap that has a down close. It's defined by this candle's low, this candle's high, even this range is that far down. This is the only imbalance. So we have a little bit of an overshoot there. That's called a mohawk. It's just a coloring outside the lines. I talked about it yesterday. It doesn't change anything. Did it take out this high? No. All it does is it went outside the boundaries just a little bit, and the next one gives you peace of mind because what is it doing? It's stopping right at the high of the fair value gap. What's the high of that candle? 18,283.75. What's the low of this candle here? 18,283.50. It's not going outside the realm of what you would expect price to reach to and then move away from. You'll never convince me that sellers and buyers stop every bit of one of these turns in all these PDA rays right to the tick or the point. And even if I didn't believe in an algorithm, I would think that it was something other than that. But the market trades aggressively after 1 o'clock, after we have a retracement. So here we have model 2022. Here we have optimal trade entry. It's easy when you have all of the guidance and rules in place and you do the things that you're taught to do, focusing on the time of day and anticipating the delivery of price based on factors that call price to it. New day opening gaps, new week opening gaps, relative equal highs, relative equal lows. And then below that, in terms of importance, you have inefficiencies. Inefficiencies are subordinate and less important than relative equal highs, relative equal lows, or new day or new week opening gaps because they're influence over price. The algorithm will refer and prefer more importance and significance placed around them. Gaps, when they're actual, like new week open and new day opening gap, that is absolutely going to be much more significant because there's a lack of trades there. Inefficiencies, you have one side of the delivery offered to it. For instance, let's go back to this one here. This sell side imbalance, buy side inefficiency has sell side delivery. Sell side delivery is always one-sidedness moving lower. Sell side liquidity is what's resting below that low. The London low, or relative equal lows that this line is here, that's these over here. That is sell side on the daily range. That's the lowest it's moved for the day, overnight, London. So it's going to want to try to gravitate to that too. That is real orders. That's not inefficiency. There's real pending orders down there. That is the lifeblood of the marketplace. Real buy stops, real sell stops. That is the heartbeat of what makes these markets go up and down. In between that, you have inefficiencies. Inefficiencies have one pass through. So they have delivery. In this case, we have sell side delivery, but what is it lacking? Buy side. If I'm bearish, I don't want to see buy side offered. because what that's telling me is I don't want to see it trade in the upper half of this. I don't want to see that at all. In fact, I'm enamored when I see it not even touch consequent encroachment. The fact that we don't touch that consequent encroachment or midpoint, that tells you what? It's really heavy. Because otherwise, it would be natural for it to come back up in here, trade there, close it in, and it could still roll over. I don't like those kind of trades. That's a sell side delivery. It's only sell side. It's inefficient in its buy side. It's not going to be balanced if it just trades up there. That's not balanced. It needs to go there and then leave it. Then it's balanced. That's a balanced price range. But the point is this. At 1 o'clock, we have an up close candle, and it pumps it. And what's it doing? That one candle is moving up. So people that are watching that and they see this go up, even though it's a 1 minute candle, that triggers people that are watching 1 minute candles. 1 minute charts is the bee's knees, baby. You can't make any money unless you're trading a 1 minute chart. When they see this do that, they're like, oh, there we go. It's making a failure swing. It's going to go up. And this is probably going to turn into an inversion fair value gap. And it's probably going to go for those relative equal highs up here. They chase something so minute and insignificant, losing the entire plot, that it's going to want to run the London lows. And now, as I taught you today, it's going to try to gravitate to new day opening gaps. And the market does, in fact, trade down below the London lows. And you can see my fill right there. So my limit order is just below that there. So if you look at the fills, 321.25, adding a partial pyramided entry of 4 more contracts at 291.25, scaling off the entirety of the position, 10 contracts at 18,213.50. So that is over 100 handles with the largest portion there, and that smokes all your favorite live streamers. And because you study and you see it and it's been journaled and you log it, you have experience after experience to lean on and say, you know what? This has been panning out like he said it was going to. And one day it's going to fail in your hands. And you're going to need to see how many times it's worked before. And that's going to be your crutch. That's your counselor. That's your remedy for stress and doubt and fear. Because when you go back and say, yeah, but look at all this. I mean, it did it this day. I thought I was going to do that. And it did it. I looked at this day here. I did this. You got months and years of looking at that and seeing how many times it works. So when it does fail in your hands, you did it wrong. I do it wrong. When I lose, there's nobody's fault in it but mine. I'm the operator. I messed it up. Guess what that does? It immediately allows you to let that loss go. But if you take that loss and you put it in other people's hands so they can criticize it, guess what that means? Now you made it into a discussion. You're asking other people that you really don't give two shits about, but you just want them to pat you on the back when you do it right. You're doing everything wrong. You have to filter that stuff out. Even when you're successful, you don't go out there and say, hey, look at all this money I made today, because you can't believe it just happened to you. If it's in your bank account, trust me, it's fucking real. Go buy something. You don't need to go on the internet and say, this is how much money I made. Here's the proof of it. Fuck that. That's a little dick energy perspective. That literally is what weak-minded boys do. A man that is understanding what he's doing, a man of principle, does not need to do those things. The fact that he was able to harvest that money, bring it home for his family, and afford himself and his family whatever they need, that's the reward. The peace of mind knowing that that's what you can do again next month. That's what back testing, that's what tape reading and demoing provides for you. And because you've desensitized yourself from being right or wrong, having to make money. See, you have to make money if you start with a live account. You have to, or you'll have to put more money in it. You're increasing the likelihood and odds of you having to do that if you skip over everything I've talked about so far. And you don't realize that the lessons you get in that stage are the very things that carry you through long-term profitable real money trading. But when you can look at the marketplace and strip it down to its chrome and say, okay, this is when the market's going to move. When? Well, at 7 o'clock, we can start looking for signatures. It's going to do something. At 8 o'clock, we start looking for signatures and see if it's going to do something. Relative equal highs, relative equal lows. If it forms relative equal lows and you've already determined it's a new day opening gap or a cluster of them, and maybe a new week opening gap, same thing, below the marketplace, wherever it's trading at when we start watching price, think of it like a kill zone. You have all of these things behind the scene that retail traders have no understanding of. Your task is to study price action by backtesting, journaling old data, and then picking out in hindsight where price did certain things. The next stage is for you to tape read watching real price action. So Caleb's got to watch nothing live this month. He's got to go through old data and collect it and show me what he sees in price, what it did. And what that will do is it gives him a foundation. of identifying baseline price action, what it genuinely and generically will do. The following month, I will expect him to watch price live when we're doing the live streams. And I'm going to point out things before it happens and tell you this is what you're looking for. This is what price should do. We don't want to see price do this. And then we do that for a full 4 weeks. After that, month 3, I will be talking about pushing the button and getting in and getting over the fear of getting into trades, because that's a skill set that you have to have. When I first started trading, I was scared to death. And I just started doing entries. I just did it because I needed to get over it. I was afraid as soon as I put in the trade, it was going to do what orange juice option did to me. It took half my money in one night. So I had to coach myself through doing lots of executions. And I got that idea from Larry Williams. But I had to develop things to get in on the trades. And over years of doing it, I was fearful that I was going to pick the wrong entry.